Ya, Assalamualaikum warahmatullahi wabarakatuh. And good morning. And today we'll look into this topic, liabilities. And for master of management, I do not plan to go very detail on this topic, but to give you some of the types of liabilities that you should know. All right, because in interpreting the financial statement, all right, the types of liabilities is also important for you to know. Okay, so for this, right, the nature of liabilities. So liabilities is defined as debts or obligation arising from past transaction or events, right? So this liability is divided into two. One is the current liabilities, and the other one is the non-current liabilities. So for current liabilities, normally anything that is due within 1 year or less, then we put it as the current liabilities. Anything more than 1 year is a non-current liabilities. So, and then we talk about what's the difference between debt and equity. All right, we talk about liabilities. Actually, it falls under the category of a debt. All right, so debt is actually the acquisition of asset by company. Remember that our formula is always that A equals to liability plus OE. So L here refers to, the debt here is your liability, and the owner's equity refers to your equity. Yeah. Acquisition of asset is financed from two sources, which is your debt and your equity. Debt refers to the funds from creditors with a definite due date and sometimes bearing interest. Yeah. So sometimes we call interest here as I, like that. All right. In the other way is that equity is fund from owners. So estimated liability. So this one is when you say that when we estimate a liability, all right, you have to have two characteristics. One, you know that the liability is known to exist. However, the precise dollar amount cannot be determined until a later date. That's why the name is estimated liability. All right. And in this area, for example, when we have we sold an asset, all right, for example, a product, for example, a motor vehicle, normally it comes with warranty, right? But that warranty amount is cannot be determined at the point of sale, all right? Because but then we still have to put in some kind of estimated liabilities, and again, this amount is not, it's not precise because the figure, the amount is not known at the point of sale. An example of current liabilities, all right, and this one is anything within one year. Right, so we have short-term obligation to suppliers for purchase of merchandise and to others for goods and services. Example is that when you purchase merchandise inventory, all right, or when you purchase your office supplies, you pay for your shipping charges, utility and phone bill, all this, anything that is an obligation, it means that it's on account, right? Whenever you have that on account, so it means that these are your liabilities. So all these are your payable. So normally this one is less than 1 year. So it's current liabilities, and normally we call it as an account payable. Then we also have the other current liability, what we call notes payable. All right. So when a company borrows money, a note payable is created. It's kind of contract, a short contract. All right. So the notes payable normally for a longer period, for more than 1 year. But for the purpose of accounting, we are going to divide the total notes payable into two. One is the current note payable, and the other one is the non-current notes payable. So if the notes payable, you're going to divide that, whatever is less than 1 year, then we are going to put that as a current note payable. And the non-current, anything that, this one is less than 1 year. And this one is more than one year. All right. Non-current means that it's a long-term liabilities. The current liability, for example, here we say that this is an example of notes payable. All right. It's a notes. So we say that San Antonio on November 1st, 6 months after the state porter company Porter Company promises to pay the Security National Bank the sum of $10,000 with interest at the rate of 9%. So this is the interest bearing notes payable, and the interest is 9% per annum. All right. So who is actually paying this? Porter Company. All right, Porter Company. This is the place lah. All right, so this one is what I say that state, for example, all right, the place of the company. So Porter Company have to pay to Security National Bank. So it's a kind of borrowing, but they issue a note payable. So the value is 10,000. By when? After this date. All right, the period is for 6 months. So when it has 6 months, that's why it's a current liability is less than 1 year. So this is not payable, a current liability, because it's less than 1 year. You may also have one which is more than 1 year, so that is under non-current liability. But again, later you have to divide that into two. Yeah, the short, anything less than 1 year is your current liability. Another type of accrued liability is what we call accrued liabilities. Yeah? Accrued liability arises from the recognition of expenses. So let me put it here, expenses here. Yeah, is for expenses for which a payment will be made in the future. So that's why it gives rise to a liability. Yeah. Accrued liability are often referred to as accrued expenses. Example, when you have to pay interest. So interest will be paid in the future, so it becomes interest payable. But remember that this is the liability portion. So if you have your expense, you are going to debit your interest expense and credit your interest payable. So the liability that we are talking here is the payable here. This one is an expense, and the second one is your liability. Income tax payable as well as accrued payroll liability. So all this is a liability, but it's a short-term liability. We call it as accrued because this one is incurred for the purpose of your expenses. We also have your payroll liabilities, all right, and then we have unearned revenue. So what is an unearned revenue? Unearned revenue is a cash that you have collected from the customer before the revenue is actually earned. Remember when we talk about, when we did chapter on accrued liability, so one is unearned revenue. So what happened is that at one point of time, you receive debit cash, but you have not actually performed the services, for example. So you're going to get unearned revenue. All right, this one is a liability. Yeah, so you have to claim because you have received cash, but the liability here is the unearned revenue because you have not performed the services or you may have not delivered the goods. Yeah, so why not moving there? The slide is not moving. Okay, maybe I'll try to stop sharing first. Stop presenting. I'll present again. It's not. Okay, so we have the unearned revenue here. There's a lagging a bit here. Yeah? The internet is not that good. When you receive cash for services that you have not performed, so that's what we call unearned revenue. So this is a liability account because you have not actually performed, so it's liability to you. You have received the cash, but you have not performed the services, or you have not delivered the goods. So that's why it is called unearned revenue. Right? So you cash receive in advance, then deferred revenue is recorded. So deferred revenue here is the unearned revenue. So once you have delivered the services and then you have number one here, all right, or you have performed the services, then you're going to record number one, you are going to debit your unearned revenue, because now you have earned the revenue and credit your revenue account. Now only you recognize your revenue. Before this is not a revenue, is a liability. This one is a liability, this one is a revenue. Okay, next. Long-term liabilities, all right, long-term liability means that it's more than 1 year. So if you need small needs of cash, all right, for example, it can be filled from single sources. For example, you can apply loan from the bank, or sometimes insurance company, you have to insure something against on your goods or services, or even you have a pension plans, right? So this one is a small debt that you need. But if you need a lot more, right, long-term liability, you see that when you need large debts, right, large debt are often filled by issuing bonds. So what is a bonds? Bonds means that you offer to the public to lend you money, right? So offer to the public to lend you money, and in return, you will pay them interest. So maturing obligation intended to be refinanced. So one special type of long-term liability is an obligation that will mature in the current period, but that is expected to be refinanced on a long-term basis. So this we're talking about refinancing, right? Maybe you can see that, right? Refinancing. So refinancing here means that you already have an obligation, right? For example, now more common is that when you purchase a house, and after a few years, because how a house appreciate in value. So what happens is that after some years, 10 years or 15 years, then the value of the house increases, but then the loan of the amount obligation or the amount due to the bank, for example, has reduced over 15 years period. So what happens is that you have the option to refinance your house. So refinance means that you put the house uh, as if, all right, you are selling the house to the bank buy the house at the new price, which is in this case, value is higher because appreciate in value. Yeah, so that is what we call refinance. So now the bank will pay you cash on the difference between your outstanding loan, all right, the old loan, right, so whatever balance, and then now you have a new loan, all right, based on the new value of the house. Okay, so there is a refinancing. And then we'll talk about notes payable just now. Yeah, normally there you have to pay by installment. Yeah, because it takes a longer period, for example, 3 years or 5 years period. So over the time, you will have to pay installment basis. Yeah, so that installment normally covers a period plus principal. All right, sorry. So we have your principal, and then you also have the interest portion, right? So you have to divide that into principal and interest. With each payment, the interest portion gets smaller and the principal portion gets larger. So over the years and number of years, all right, as you go along, all right, your interest, and then this one is your loan. Interest lower, a loan is loan repayment. Yeah, loan repayment will be higher. But don't worry about this. It's just that remember, for this, I only wanted to introduce you on the types of liabilities. But you should know lah. All right. For example, when I say that notes payable, then normally you are going to pay installment. Installment plus principal plus interest over a certain number of years. All right. Okay. I will not go into details of the computation. All right. And then we have bond. All right. Bond here, types of bond that we have means that again, bond is when you open to the public to buy your bonds. So public put money into your bank, you will pay them by installment over a number of years. Yeah. So when for example, when you issue bonds, all right, you will get cash from the public. So you're going to debit your cash and then you credit your bonds payable, right? So but this bond payable over time, you will have to pay out, so that you're going to pay a small amount credit cash, debit your bond payable. So over the time, the bond payable reduce, right? It will depends on the agreement. All right. So for example, here when you have to pay bond interest expense, all right. So in this case, the bond is 1 million, interest is 6% and over half year. So you're going to record this one over half year period. So 1 million times 6% per annum, but the period is only for half year. So it means that you're going to make two payments in 1 year. So whenever you make payment, the 30,000 here is not the bond, it's not the principal, it's only on the interest portion of the bond. Okay. All right. So I will not go very detailed on this. I do not expect you, all right, to do a journal entries on this bond and interest payable, everything. Yeah. Then we have still bonds here. Okay, we'll talk about bonds here. All right. Sometimes we have bond that is issued at a discount. We have bond at par. We have bond at discount. We also have bond at premium. So what we mean by discount at discount means that a bond here, the principal value is 1 million right here, but the issue price is 9. So this is what we call discount. So it means that you offer the bond at a lower price, right? It should be 1 million, but you offer at 970 only. So the difference in 30,000 is the discount that you are actually giving to the bondholders. So the rate is given and the interest dates is paid on the every 1st September, 1st September and 1st of March of every year. And this bond takes about 20 years. So that's why it's a long-term liability. Yeah, it's more than 1 year. Okay, but then issue at discount, right? Issue at premium, example here, where is it? All right, the principal is 1 million, but the cash that you receive, you offer the bond at a premium, which is more than the principal value. Right, so in this case, the 30,000 here, the difference between the principal and the cash proceeds, 30,000 is your premium. All right, so um, so why you issue a premium? Maybe the rate is very good for the bondholder, so they say that I'm willing to pay more, all right, for the interest that they're giving me, for example, yeah. Loss on contingency is okay. I think that all right, interest coverage ratio, evaluating the safety of creditors' claim. So again, when we talk about the ratio here, all right, we will focus this topic later on the financial statement, the interpretation using the ratios, for example. So this ratio, evaluating the safety of creditors' claim, they call it as an interest coverage ratio. How to compute this interest coverage ratio is your operating income over interest expense. Yeah, this ratio indicates a margin of protection for creditors. From the creditor's point of view, the higher the interest coverage ratio, the better, right? It means that the company has a lot of income as compared to the interest expense that they have to pay. All right, how much debt should a business have? It depends on the effective use of leverage. Using borrowed money to finance business operation is called applying leverage. The more leverage a company applies, the greater effect of the income and the return on equity. So for example, here, relationship on return of asset, all right, and interest rate on the borrowed fund is a bit technical, all right. So, but if your return on asset is more than your interest rate being paid, so that is good. Yeah, so your income will be higher. But if your return on asset is less than the interest rate being paid, right? So what it means is that, remember that you use this money that you borrow, the borrowed money, all right, the borrowed money you use to finance your business. So this financing of your business that give you return on your asset. All right, return on assets. So assuming lah, for every money that you borrow, you generate RM 10 ringgit. But, sorry, not RM. Okay, RM 10 ringgit. But the interest that you have to pay is RM 8. So it is good because why? Your return on an asset is more than your cost. So this one is your income. This one is your expense. Your interest that you have to pay is your interest expense. So this one, your income is more than your expense. That is good. All right. That's why your net income will be increased. However, if your return is RM8, all right, RM $8 ringgit, but your cost, all right, is you have to pay interest of 10 ringgit. So this one is not good. Why? Because not good because your cost is more than your income. So that will decrease you punya net income. All right. So, talking about ethics, fraud, and governance related to debt, the most infamous financial fraud in US history occurred at Enron and was revealed in the fall of 2001. So, this is a very important case whereby the company, all right, major part of the Enron fraud involved understatement of debt. Yeah, they understate their debt, so into shows that the company is very good. Yeah. Enron understated debt by at least 550 million each year from 1997 to 2000. Why they understate the debt? Because they want to look good, all right, to maintain a high credit rating from these two companies, Moody's and Standards and Poor's. Right. So that's why they show, we have a very good credit standing or rating because as you can see our debt is very low, but actually they understate their debt that give rise to the issues of ethics and fraud. And then we also have special types of liability. This one I think that it is the last one. All right, special types of liabilities common to most large organization, what we call lease. All right, is a contract where the lessor or the owner of the property give the lessee or the renter the right to use an asset for a specified period of time in exchange for periodical rental payment. So I have an asset, I lease to you, you pay me rental. So that rental is an income to the lessor. All right, but to the lessee, the lease is a liability. Post-retirement benefit is an obligation of the employer for benefit the employee earn the rights to receive while they are working for that employer. So they have to put aside some kind of post-retirement benefit amount, all right, because upon retirement, for example, the employee is entitled to receive certain amount from the employer, right, for the post-retirement benefits. And we also have what we call deferred tax. All right, deferred tax here is that because the accounting and the tax are two different laws. Yeah, because of the timing differences between uh, income taxes and the accounting profit. All right, that give rise to a deferred taxation that you have to pay in the future. So that is a liability that has to be recognized because you have to pay the tax in the future. Right. I think that's the end of chapter 10. I'll see you again, inshallah, next class. Assalamu alaikum.